All right, investor friends, it is time. Time for the Mike's Market Update for August. I apologize. Last month came out pretty late with everything that was going on. That's just kind of what we dealt with. So bear with me on that, and let's dig into August here. So we're going to go over July's numbers here locally, but on a macro level, I do want to talk about BlackRock. I didn't, with all the inflation stuff and what was going on with the Fed, I didn't get into Wall Street, and I do want to touch base about that. We'll dig into some forbearance, some mortgage credit availability. Everyone knows how much I love that. And then my thoughts on what's going to be happening at the Fed's yearly summit coming up in Jackson Hole here in August. And on a local level, we'll do a COVID recap again. Affordability numbers are out, so we'll jump into those as well. And also the importance of knowing your data, because RMLS made a very large error this month that will get fixed because I gave them a heads up to their error. So let's talk about the macro here. We're not talking about inflation. Apologize for that last slide, but we're going to get into Wall Street. So Blackstone bet $6 billion on shifting path to suburban homes. And a lot of talk I hear is Wall Street's buying up America. Wall Street is buying all the housing. And that quite simply is not true. There are definitely some communities, typically cheaper suburban communities, where you can get a lot of single family homes for much cheaper than you can get them here in Portland. They have a larger percentage, but as the whole, they have a very, very small fraction. It's less than 5% of all the real estate in America does Wall Street own. So they're not a threat to owning real estate. And in fact, when we dig deeper in beyond the headline, what they actually did is they bought Home Partners of America. And what is Home Partners of America? They own 17,000 single family homes, and their business model is renting them on a lease option to purchase. So this is actually a path to home ownership. So all the headlines that you see that Wall Street is keeping people from buying homes or keeping people from home ownership, it simply is not true. A, they don't own enough of market share, and B, a big portion of what they just bought is actually giving home ownership to people. So again, get past the headlines, dig into the actual stuff of what's happening on. This is one of the reasons we do have a floor, though, in the value of real estate, because as I've been saying for over a year now, we are in a low yield environment. Macro money, institutional money has very few places to invest to get yield. And so what does that mean? They can go to real estate and they can buy 4 caps, 3 caps, 5 caps, whatever market they're in, they can buy low rates of return, and that yield is significantly higher than what their other options are for putting their money. And so that does keep that tide high, or that floor very solid from a real estate standpoint moving forward. And then a quote, I like this quote from Jeff Lambon, who's a Bloomberg analysis: smart people, smart money want to get a piece of that. So smart money is going into real estate. And so again, why am I not concerned about real estate? We'll get into forbearance numbers here pretty soon, but we do have a very, very solid floor right now. This is not 2008. We don't need to worry about the bottom falling out of the real estate market. There's too much money out there. That too much money wants a piece of that, and it will continue to flow into real estate and make it a low risk investment. So getting into forbearance dropped to 3.26%. So right after COVID, forbearance jumped into the high single digits. In fact, I think it jumped potentially into the low double digits when it first happened. And we've just been seeing those numbers consistently come down, come down, come down, come down. I wanted to do this month is let's look at the actual details of those. So by stage, 9.7% are in the initial forbearance plan stage, right? And so that's a small percentage of loans are now recently going into forbearance. That makes sense given all of our chaos was last year. The initial rush to forbearance was early on in COVID, April, May, June. And we just haven't seen as much of that as the economy's picked up. And so fewer and fewer people going into forbearance, which is obviously a good thing. The big percentage of all those people in forbearance are on an extension. Okay. Now that could be a thought for concern, but again, we can dig deeper into the numbers and see if there really is concern there. But that's also an example of what is the government going to do. Again, they're providing help. We've seen that from all these various stimulus packages. The government is taking responsibility in their role in shutting our economy down or slowing our economy down significantly. And so they're going to do whatever necessary to keep people afloat. And one of those being is forcing servicers and forcing mortgage investors to extend forbearance. So they want to see loan mods, they want to see forbearance, they want to see working with homeowners, mortgage borrowers to get out of trouble rather than just, short sales and REOs are the way we're going to get through this. So again, it's not 2008. How did we get through 2008? 2009, 10, 11, and 12, we just did a record amount, a ridiculous amount of REOs, so actual foreclosures, and then short sales, and then a very small percentage of loan mods. I've been saying ever since COVID started, we're going to flip flop that, and that's what we're seeing. The data is pointing out to that. Only 7.5% are people that are going back into forbearance. So they went to forbearance, came out of forbearance, then found hard times again, probably because of the Delta variant, and jumping back into forbearance there. So of the exits, let's dig into that. So only 28% resulted in a loan deferral or a partial claim. And so that means they're exiting with success. Okay, so I shouldn't say only, this is good. The highest number of the exits, they're exiting with success. So a partial claim or some type of loan deferral. So meaning they've come to an agreement with their lender, they're exiting forbearance, and now they're on a plan to success. Almost a quarter of the people that were in forbearance were actually making their payments. And that makes sense. There's a lot of confusion when forbearance first came out. A lot of people just were opted in. Some people didn't want to be opted in. Some people opted in even though they felt like they could, and they were just protecting themselves from the future. And so a significant amount of people were actually making their mortgage payments even though they were in forbearance. And then 16.1% did not make all their monthly payments and exited with the loss mitigation plan. So in up here, what we're saying is this is an actual kind of a loan mod, right? Here's a mitigation plan, meaning maybe they're not on as solid ground as they want, like this group up here, but there is some type of plan in place. And again, that's a small percentage of people that actually entered into forbearance. So look at this. More people actually made their payments than people that didn't make their payments. Okay. So again, we're not really too concerned about that. The big forbearance rush to forbearance was more of a preemptive thing, not a I'm really in trouble thing. Reinstatement. So 13% reinstated their loan and they paid everything back. Okay. So again, a good significant portion. So let's get into this. About 50% people were preemptive, and most were making their payments. 25% had some sort of loan mod, and roughly 9% no longer in that loan. And then what I want to really show is this: 1.4% resulted in short sales, deed and lose, or other reasons. Okay, so a very small fraction of everyone who went into forbearance actually exited in a level of distress that meant, hey, we're giving up. We either sold our property as a short sale, gave the property back to the bank, or other reasons. We can't get into an REO. Banks can't take properties back right now because of the moratorium. But again, that's reality of what happened, and it's opposite of the fear talk that I hear. So I still see people, gurus, talking heads saying that we're going to see a rush of foreclosures. The smart people are saying and agreeing with what I'm saying, which is we're not going to see a rush of foreclosures. It simply will not happen. Too much cash on the sidelines to actually buy short sales. So to the point where they actually get to the REO stage isn't going to happen, or at least a small percentage of it will get there. There's so much equity on the table. Borrowers, there is not enough inventory. By the time there's so many potential solutions before anyone actually has to give their property to the bank. And what do we also want? Banks don't want the properties. We know that banks don't want the properties back. Banks want to exit in a different fashion. And so even though REOs and foreclosures, that was the gamut of 2008, 2009, the large percentage of all the distress went to the banks, and then the market was flooded with bank-owned inventory where they're a not typical seller, they're not typically motivated. It's completely flip-flopped. That's going to be the very smallest amount of proportion of distress that actually gets to the market. So not too concerned about that. Great news on the commercial multifamily borrowing. So we're up significantly. So we expect to be up Q2 of 2021 compared to Q2 of 2020. We expect a significant increase. And I think it was like 106% increase. But what's really good news here is the numbers for 2021 Q2 are greater than Q2 2019, which is record volume. So when you look at the amount of borrowing in the commercial world, the multifamily world, Q2 2019 set a record, and then we set that record again this past Q2. And we're up significantly from Q1 in 2021. So what does that mean? That means lenders are feeling good about that asset class. Borrowers are feeling good and have the ability to borrow. And so money's flowing in that market segment. So for commercial multifamily, and that is a lot of different asset classes. So this is a broad look at it, but the feeling is good. And remember, we understand emotions drive markets, right? So less so in the investment world and in the retail world, but money has to flow. And for money to flow, lenders and borrowers have to feel good about that. And that's what we're seeing here. So again, that's a great news for real estate and the stability of real estate. Mortgage credit availability, we rose again after a drop this summer. I need to get into this. I haven't looked in this the past couple months. I'm not really sure what happened there, but we saw the COVID drop, a little rehab, another drop, and then a rehab, mortgage credit availability coming back, and then a big drop again. Very small comparison. This bigger drop here is similar to other drops that we've seen historically. But again, mortgage credit availability is high. I do want to break it down. So this is overall, when you look at all the different types of loan lenders or programs out there, MBA Mortgage Bankers Association breaks it down also into the different aspects. So you can see conventional flows very similar chart to what we saw on the overall level. What's interesting here is government doesn't, right? So government has a lot less volatility to it. And why does that? Because the government loan programs don't change very much. And the people that can access it don't change very much, because we're talking about low down payment programs. We're talking about pretty steady interest rates, right? The government interest rates typically your lowest interest rate. Mortgage insurance will affect that a little bit, but much more stable portion of the market. Jumbos actually track pretty similar to the overall. What was interesting is this conforming. So your conforming loan programs, those are the easiest to sell in the secondary market. They're reacting a little bit differently. Their scale's different, so I think that has to play here. So I don't have a lot of detail on it, but overall, mortgage credit availability is there. It's better than it was in our Great Recession. It's back down to the 2014, 2015 levels that we've been talking about for a year. So credit is flowing. And as I talked about, what do we need? We need two things: people feeling good and borrowing money, and investors, lenders feeling good and lending money. And that's still the case today. So the Fed has their big economic policy symposium coming up in Jackson Hole in August. This is a big deal because it's when they can actually give clarity or give clarity to the markets, or I should say the markets want clarity. And so they're looking at this meeting as a point or a time where the Fed can now give clarity to the markets. And so this is what they're trying to get inside. Tapering, right? We've talked about tapering I talked about it quite a bit last month, but if they're 80 billion that they're buying in government debt and 40 billion in mortgage-backed securities, when are they going to do that? And so they're hoping for consensus around interest rate forecast in 2022 and 2023, and actual stronger verbiage on when they will start tapering. I don't think that's going to happen, though. When you look at my prediction, I just don't think it's going to come. That's not where the Fed's position is. And when I look at big quotes from CEOs of Wall Street, it's like they just haven't paid attention since the last year's Jackson Hole Symposium, where the Fed released their new policy framework that said, we're not going to react to inflation and employment. We are going to react to outcomes that have happened in inflation and employment, but we're not going to guide the market. So the Fed no longer wants to guide the market. They don't want to be preemptive. They want to see what actually happens. And they'd rather make a move too late than make a move too soon. So I don't think the markets are going to get this clarity. There will be some talk about tapering. There will be some discussion about interest rates. But again, that's not their job to give markets clarity. They don't feel like that's their job. Their job is to react to how the markets are happening, react to how inflation is happening and employment's happening. And so now, will they talk about raising interest rates earlier? Yeah, I do believe they will talk about that. And as we see inflation come out, they have the tools to fight that. And then the market will react to that. If they do start having stronger verbiage, they become less dovish, they become more hawkish, and they actually say that we will use the tools, because they do have tools to use to fight inflation. They can taper, and they can stop buying all this debt, and they can raise interest rates. And so when they do, expect money to flood out of assets like the stock market, like gold, like Bitcoin. And then what are they going to buy? Well, they're going to want to buy less riskier things. So they're going to buy the 10-year treasury note will be something they buy, which will put downward pressure on downward pressure on mortgage rates, mortgage interest rates, which puts upward pressure on real estate values, and they'll also buy real estate, right? So we talk about that low yield environment, they'll go and buy real estate. So whatever the Fed does, it's going to be good for real estate, in my opinion. Now it could slow down the market and it slows down unemployment, that's against what they want to do, right? One of their mandates is full employment. So they'll be very careful at what they say and how fast they move, because they don't want the markets to go down, and they don't want that to hurt the economy from a jobs perspective. And so it's a dance that they're going to have to battle, and they know they have to battle it. And I do think they'll take very slow, measured steps. And because they're slow and because they're measured, it won't create a lot of ripples in the real estate market. So that's my thoughts on the macro level. Let's get to the micro level here in Portland. So again, supply levels went up. Oh my gosh, it's so amazing. But it's also been expected. We've been talking about this, that this is the time of year where we should see that start to happen. Let's get into new inventory, new listings. So this is new listings. Here we go. Now we're kind of getting back right into where we said new listings actually dropped down a little bit, but that's common. We expect new listings, fewer sellers to come to the market this time of year. So that's not much that's expected. Going back to this number, don't get caught up in this number so much. So if you take 1.1 month divided by 0.8 months, that's a 12.5% increase in supply levels. Now that correlates to inventory this month, which we'll get to next, but this isn't inventory. Remember, this isn't inventory. This is supply levels given the competition in the market, competition amongst sellers, competition amongst buyers. So when we get into inventory, look at our inventory. So we've kind of hit our bottom in the winter of 2020 and 2021, and we've been steadily rising since. And what's happened is our demand has been pulling back. Okay, so that's why inventories are going up. Inventory levels are going up. Demand's pulling back. We'll look into that. So pending sales leading indicators. So the orange is 2020, the blue is 2021. And so you can see, other than in May, we've been less and less and less since we got off that COVID cliff, right? So we saw the rebound and we saw demand going down as it typically should, but we've seen demand on a pending sale level head and shoulders over previous years. And we still have that, but just not to that same level extent. So what are we going? We're going from a very, very frantic seller's market to a seller's market. But it's still a seller's market. So don't listen to some of the verbiage I'm hearing, which is prices are coming down, homes are sitting longer than they have been. No, that's not true. You may see more inventory, which is true, and you may see some homes sitting longer that aren't priced correctly, but the market's not going down. We talked about what market value is in detail last month, and I highly suggest going and watching that video to see about that. There will be a calibration of what market value really is, because when 8 out of 10 sales are a bidding war, what we're seeing reported as a sales price isn't necessarily market value. One party does not make a market. I've had this discussion with a lot of brokers who kind of challenged me on my thought process last month. And now, while a willing party is willing to pay a certain amount, when it's an exacerbated market and they're just outbidding everyone by $10,000, $20,000, $30,000, and everyone else is grouped into a certain value, the market's speaking. So this one willing party may be head and shoulders above everyone else, but all those other offers are grouped together. Market value is down here, not what's actually getting reported. So that calibration will happen in the market, but demand is still strong. So don't get disturbed. Demand is still really, really strong compared to historic months. Closed sales track a little bit slower behind. And so closed sales are higher than what we saw from last year, but we're going to be on that trend. So we're on the downward trend that time of year, the seasonal time. So expect this number to start coming down. Now, the question is, are these blue dots going to be below the orange or above the orange? I have a feeling that we'll be below the orange. Okay. So in this gap here is where we'll be. So we'll be ahead of the years of 19, 18, 17 and 16, but less than 2020 because prices are a lot higher. Okay. We'll show affordability. Affordability's come down a little bit. And the market's less exacerbated. We have more inventory. And so now they can buyers can be less stressful. They can make better buying decisions. Let's look at our COVID cap. So we kind of broke this down into, the last half of 2020, first half of 2021. And what I want to see is what's the total numbers of inventory. So we're going to look at listings, pending sales, and closed sales. And so you can see while inventory listings are up compared to 2020 and 2019, so that's partial COVID, partial not COVID, they're still right in line. So we don't have we're not getting flooded with inventory, right? And so new sellers are not bringing our supply levels back up. It's demand pulling back. And so when we worry about market value going down, that can happen from two ways. Lots of sellers coming into the market or lots of buyers leaving the market. And we're not seeing either. Okay, so we should expect supply levels to go up, and I predict that they'll be up above 1 month of supply before we get to the end of the year. But that's still a seller's market. It's just not a frantic seller's market. So understand that when we're getting into real estate. Now, I do expect the values to potentially go down or at least flatten out, which they have, and we'll show that in here shown as well. Pending sales. So again, this is, I go back. Pending sales. Now this is significant. Look at this increase compared to previous years. We're up almost 20%. That's significant, right? And so that's demand. That's an accommodative monetary policy. When you're buying $40 billion a month of mortgage-backed securities, that puts more money into the mortgage market, which means investors, right? So mortgage officer gives you a loan, or a bank gives you a loan, they go and sell that to the secondary market. The secondary market is packaging those and selling those to the Fed. So then that investors in the secondary market have more money to buy more loans, which means banks and mortgage officers can give more loans so they can be bought and they can be sold. And so that's the process, and that's leading to such an increase in demand. And then in the closed sales, same exact thing, significant. So we're about 20%, 15 to 20% here increase in demand. So we're going to continue to see an accommodative monetary policy for the rest of 2021, for most, if not all, of 2022, and I expect for the first half of 2023. So expect demand to stay high. So that creates a floor to value, potentially even more upward pressure on value. And we get into affordability, we still have room to run on affordability. So again, I'm not really concerned about the market. Now, don't expect to get bidding wars, and don't expect everyone to just outprice everyone. It'll happen. There's going to be bidding wars. There's going to be people getting really good prices. But be very careful when you're looking at your numbers and running your numbers for flips. Days on market. So again, what I keep hearing, houses are sitting on the market. Houses are sitting on the market. Well, the data doesn't prove that out. Okay. The data is days on market have come down 40% from last year. Okay. And so houses are not sitting on the market as a whole. Some individual houses that you may be looking at and you may be seeing prices coming down, you may be seeing sitting on the market. Well, that's an inexperienced broker not pricing property the right way. Because in this market, if you haven't sold in 2 to 4 weeks, it's a pricing issue. We put a duplex on the market, and we priced it too high because we wanted to get a high price. We wanted to kind of test the market. And once we did a price reduction, then we got competition, and we actually got it bid up to a price higher than our original list price. Okay. So finding that pricing sweet spot is really important. And marketing times days on market is not matching up with some of the comments I'm hearing in the marketplace. Affordability. So you got to know what goes into equations, what goes into these numbers. So if you look at affordability, it looks like affordability has just dropped like a rock since winter of 2020. That does kind of make sense because what's happened? Prices in December 2020 were much lower than they are now. But what's also happened? So what makes up the affordability equation? It's the median sales price. It's a 20% down payment based on median income. So income in there, and then interest rates. So we dropped in March because prices went up and interest rates went up, right? Right in March is when we saw that spike in interest rates. Since then, they've come back down. But as inflation was a concern and institutional money was moving out of the 10-year Treasury note, so yields on the Treasury note went up, mortgage interest rates went up, interest rates went up, and we saw that happen. What we're seeing here, though, most of the price increase, so since March, interest rates have come back down and prices have gone up, but the interest rates have really offset that. So it doesn't make sense. This doesn't make sense. Our affordability is more than 100%. So what do? We got to actually look at the numbers. RMLS did a huge error when they reported this. They just put this out last week. They used the wrong income numbers. So income numbers come out in April, and they come out per HUD, and they come out one time per year. And it was 96,905, something like that. It's 96.9 was the rounded number for income. Well, the number that they used for income on June's numbers was 85.5. Okay, I called RMLS. They admitted they just made an error. So if you look at that, if you put the right income number in there, 96.6, affordability is actually 116%. So RMLS, I actually talked to them. They're actually going to republish that report. Affordability is actually 116%, not 103%. So that's much different. We're not dropping off a cliff from an affordability standpoint, at least from March. And prices have gone up. And so the affordability has gone down a little bit because interest rates have come down, but not significantly. Income stayed the same because, again, income only comes out once a year. But it is down from December. And we do expect that because interest rates were low and pricing was low. And the income was a little bit lower. So that's what we see on an affordability standpoint. Not too much to see here. Average sales price actually came down just a tick, less than 1% here. Again, average pricing is more volatile. Median pricing went up just a tick at even less than a quarter point. Big thing here is days on market. So days on market are down 44% year to date. But again, year to date increases on the average price and the median sales price are significantly high. We cannot keep that pace. Now, we can keep a flat market. As per affordability, we can still see values go up a little bit, but we're not going to be seeing this 2+% increase in values month over month over month. That's just not going to happen. So there you go. If you have any questions, don't hesitate to reach out. Cell number, email, and at Rarebird Real Estate or at Rarebird Mike on Instagram. Happy investing. Hope everyone's doing well. We'll see you next month. Adios.